Welcome back to Investing Talk Podcast.
Today we're looking at Oklo.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. We've got a lot of new information, particularly after their Q3 2025 earnings report.
And the initial news was, let's say, not great.
No, not at all. The company reported an EPS loss of -20 cents.
Which was a big miss, right? The forecast was for -13 cents, I think.
Exactly. So that's a negative surprise of almost 54%. And, the stock took a hit in after-hours trading.
Well, sure. When you're a pre-revenue company, every single quarter is under a microscope. And that operating loss, what was it, 36 million?
36.3 million. It really shows the kind of cash burn you need for this kind of development.
But I think we have to look past the near-term losses here. That's not the real story, is it?
Not at all. The real investment thesis is all about execution and this long-term regulatory momentum they seem to be building.
Okay, so let's start with the bull case. You mentioned the cash burn. So how do they survive that? Let's talk about the balance sheet.
This is where the story gets really compelling. They have what you could call a fortress balance sheet. Oklo ended the quarter with about $1.2 billion in cash and marketable securities.
1.2 billion.
Billion, yeah. That is just a massive amount of liquidity for a company at this stage.
So given their guidance on cash use, what does that actually translate to in terms of a runway?
Well, they're guiding for between 65 and 80 million a year in operational cash use.
Okay.
So if you do the math, that gives them a runway of, potentially 7 to 18 years.
7 to 18 years. So they can fund their operations for that long without feeling any immediate pressure.
Exactly. That kind of liquidity is almost unheard of in this space, and it supports their really ambitious vertical integration strategy.
Right, because they aren't just building a reactor, they're trying to build the whole fuel cycle.
That's the key. And we saw a huge move on that front this quarter with the Tennessee Advanced Fuel Center.
The $1.68 billion facility.
Yeah. And that's set to be the nation's first privately funded nuclear fuel recycling facility.
Which creates a huge competitive moat, I'd imagine?
A tremendous one. It means they can convert used fuel into new metal fuel for their powerhouses. They're not waiting in line for HALEU like everyone else.
And this is where the government angle gets really interesting. It's not just recycling. It's about leveraging existing government assets.
Yes. Management has been talking about the potential to use up to 20 tons of surplus government plutonium.
Plutonium, which for the government is a liability they need to get rid of.
It's a massive liability. And Oklo's tech, their fast reactor design, can actually use it as fuel. It can burn things that traditional reactors just can't.
So they're basically turning a national security problem into an energy solution.
Precisely. They estimate that plutonium could be converted into about 180 metric tons of their Aurora fuel.
And what does that mean for deployment?
It could mean they don't even need uranium enrichment for their first 10 or 20 powerhouses. It just accelerates everything.
So that's the fuel side. It sounds solid, but what about the actual construction? Getting shovels in the ground.
Well, they've already broken ground on the Aurora powerhouse at Idaho National Laboratory.
At INL, right.
Yep. They're moving from the drawing board to actual heavy construction.
And they also secured a deal with Siemens Energy, didn't they, for the power conversion system?
They did, which is a critical long-lead item. And this is another smart move.
How so?
They're not trying to reinvent the wheel. They're using proven industrial components like the SST-600 steam turbine. Stuff that's already out there and works.
So they're focusing their innovation only on the reactor core itself.
Exactly. It reduces the construction risk significantly.
Okay, but the biggest risk in nuclear is always regulation. The NRC can stall projects for years.
And this is where things get even more interesting. They've been selected for 3 projects under the Department of Energy's new reactor pilot program, the RPP.
And what does the RPP do differently?
It gives them a DOE authorization pathway that runs in parallel to the traditional NRC review.
In parallel, so they don't have to wait for one to finish before starting the other.
Correct. It's designed to cut down on all that regulatory idle time that just kills these projects. They can start building under DOE oversight.
And we're already seeing that speed, aren't we? The NRC accepted one of their reports in just 15 days?
Yeah, the Principal Design Criteria report, that's about half the usual time. It signals everyone is prioritizing this.
So what's the target for the first powerhouse to be operational?
They're targeting late 2027 to early 2028 for the INL facility.
Wow. Okay, so that's a very bullish case. Strong cash position, a unique fuel strategy, and an accelerated regulatory path. Let's pivot to the risks. What are the big headwinds?
The first one, and it's a big one, is dilution. They filed a shelf registration that allows them to potentially offer up to $3.5 billion in securities.
$3.5 billion. That's a
Yeah.
lot of potential new shares hitting the market.
It is. And while they need the capital for the build-out, it's a significant risk for current shareholders.
And on top of potential dilution, there's been some insider selling.
Quite a bit, yeah. In the last 90 days, insiders sold over 500,000 shares.
Including the CEO and CFO.
Right. Now, management calls them strategic liquidity events, which can be true, but the market sees those headlines and, it can weigh on sentiment.
Sure, you combine the threat of dilution with executive selling, and it creates a psychological hurdle.
It does. And then finally, you have to look at the valuation itself.
Right, it's a zero revenue company.
A zero revenue company with a price-to-book ratio of over 22.
22. So you're paying a huge premium for assets that are still mostly on paper?
You are. The market cap is floating somewhere between $13 and $17 billion. It's pricing in enormous success years before it happens.
And that explains the huge split among analysts, I guess.
It's an extraordinary range of views. On one hand, you have analysts with targets up to $150, even $175 a share.
Because they see the regulatory momentum and the fuel advantage.
Exactly. They believe the premium is justified. But on the other side,
You have analysts initiating coverage with basically a sell rating.
right, they just can't get past the valuation and the execution risk for a company where revenue is still years away.
So to sum it all up, it's a classic high-risk, high-reward play.
Absolutely. The bull case is all about the cash, the fuel access, and that accelerated federal pathway to get to that 2027 operational goal.
And the bear case is dilution, insider selling, and a valuation that already assumes they execute perfectly.
It really is a pure execution story. The next few quarters won't be about earnings reports.
No, it'll be about seeing concrete being poured at INL and hitting those licensing milestones with the DOE and NRC. The focus is entirely on the build.
If they hit their timelines, if they can scale that fuel recycling, the payoff could be tremendous.
But the volatility isn't going away anytime soon. It's a battle between future potential and present-day risk. Make sure you stay subscribed to the Investing Talk podcast for all our future market analysis.